Hey everybody, welcome back to another edition of 5 Question Friday, where I do my best to answer questions you all have sent in. And as always, you guys have just outdone yourself. We've got 5 great questions. Let's take a quick look at them. 1, are bonds a better deal than stocks right now? 2, how should required minimum distributions affect how we invest the money, particularly if we don't need to spend the RMDs? 3, what is the efficient frontier, and can it, or how can it, or can it at all, help us with our investing? How should we factor in illiquid investments, investments you can't sell easily, maybe not at all for some period of time, into our asset allocation? And then finally, are short-term bonds better than longer-term, think intermediate-term bonds, in a diversified portfolio? 5 great questions, and we're going to tackle them today. And if you want to send in a question, just subscribe to the newsletter with the link below this video. It's free. Or maybe I should say it's priceless. I really do think it's a really good newsletter. I'm just saying. It goes out every Sunday morning, and if you hit reply, I'm behind, but I do get to all the emails. I don't always reply. I do my best. But that's where I get the questions for this show. So you can do it that way. So with that, let's dive into the actual questions. And so number 1, are bonds a better deal than stocks right now? This came up, this was from Frank, and he mentioned a Vanguard article that we've actually looked at a bit before that kind of said, well, not kind of, but they kind of recommended, they did recommend a portfolio of 70% bonds, 30% stocks. Let me show you that article. Here it is. I'll link to this below the video. You can see what they call their benchmark portfolio here, 60% stocks and 40% fixed income, which is just a fancy way of saying bonds. But their time-varying asset allocation, now that's a fancy term, basically just means, given current valuations, what should we do? And over, I say, the next 10 years. And they said 30% equity. So they cut their stocks in half from 60 to 30 and put all that money in fixed income. And that's really the source of the question. Should we be doing that? Does that make sense? I mean, maybe we don't follow this specific recommendation, but how should we think about stocks and bonds? And it's a timely question because it's something I've been giving a lot of thought to. Here's my take. I think U.S. stocks generally, so we think of the S&P 500, or you could even look at a total U.S. stock market fund. They're a little different. The total U.S. stock market's going to have some exposure to smaller companies, but because it's all of them are weighted by the market cap of the companies, and a handful of companies, think NVIDIA, Amazon, the Magnificent Seven, maybe it's the Magnificent 4 or 5 now, but I've lost count. But they make up, we'll call it 30% or more of the index, whether we're talking about the S&P 500 or even a total U.S. stock market index. They're really expensive. And one way to think about that is with what's called the earnings yield. Let me show you that. Here it is. This is from the same website where we get the Shiller PE. All the earnings yield is, you're probably familiar with the PE ratio, the price of a stock or even the price of the S&P 500 over the earnings per share that are generated. So if a stock or an index is trading at $100 and its earnings are 5, 100 divided by 5 is 20, that's the PE. And the higher the PE, the more expensive relative to earnings a stock or an index. All we do with the earnings yield is flip the math. Instead of price divided by earnings, it's earnings divided by price. And because we flipped it that way, the lower the number, the more expensive stocks are. And you can see right now, they're at 3.32% is the earnings yield. So one way to think about that is, for every $100 in price, the company or group of companies, if we're talking about an index, earns $3.32. All right. And as you can see, it's not at the all-time low, but it's pretty low. And in fact, we got a goofy ad here. You've got the average at 722, so it's well below the average. And by the way, if we looked at the PE, we would see the same thing, just the numbers would be different. And so it's fair of you to ask, well, Rob, why didn't we just look at the PE? Why are you showing us the earnings yield? It's because I like to compare this to the yield on the 30-year bond. And the reason I picked the 30-year bond is because we can think of a company as sort of a bond that never matures. It's a perpetual bond. Obviously, there are some big differences we'll talk about. But if we compare that 332, here's the 30-year bond. I'm recording this actually Thursday evening, even though I'll publish it tomorrow. And there it is, 4.8. And so right now, the yield on a 30-year Treasury is significantly higher than the earnings yield on the S&P 500. Now here, you might say, well, Rob, that's fine, but you're kind of comparing apples and oranges. For one thing, that yield on the bond, the 30-year bond, if you buy that bond today, that's what you're going to get, but it's never going to go up. It's not adjusted for inflation. You're going to get that, but that's what, it ends there. And if inflation's really bad, you might regret that decision. But with a company or an index, its earnings yield right now might be low, but they can grow their earnings. And hopefully they will. They invest wisely. Earnings generally go up for the S&P 500. And so they can grow their earnings. And I would say to that, true enough, but I would have two responses to that. The first is that 3.32% earnings yield, that doesn't all go to us. Yes, some of it does in the form of dividends. Yes, some of it does in the form of share buybacks. But some of that money, companies have to reinvest into their business just to keep the lights on, not to grow the business, not because they're opening new stores or developing new products, but just to keep the things they already have in motion working, like replacing trucks that age, or computers that get out of date, or if it's a railroad, they got to replace the train tracks, or utility, a car manufacturer, they have very expensive equipment they need to replace. And so that 3.32% earnings yield is not all belonging to us, something that Warren Buffett calls owner earnings. What he'll say is, let's subtract out the amount of those earnings that companies sort of need to keep on hand just to keep the wheels turning. We get what's left in one form or another. Again, it could be a dividend, a share buyback, or it could be investing in the business, not just to keep the lights on and the wheels turning, but to actually grow the business in some way. Think Chipotle opens up new stores, for example, right? So that earnings yield, it's not the same as the yield on a bond. You're going to get all of that money. But the second thing is, it doesn't change the fact that right now stocks are very, very expensive. That's why the earnings yield is so low. Yes, the companies in the S&P 500, hopefully they will continue to grow their earnings. But even if they do, it doesn't mean that they're going to continue to trade at such elevated levels. Now, I'm not here to predict when the market's going to go down or that we're in a bubble. You hopefully know me well enough by now to know I'm not going to do that. But I don't think trees grow to the sky. Eventually, these high valuations will come down. And comparing the earnings yield to the 30-year bond yield, I think, is a good way to gauge just how expensive, in this case, the S&P 500 is. And it's very expensive. Now, what am I doing about that? Well, I've not gone in and sold anything. I've not sold any of my shares of total U.S. stock market. However, I have a very diversified portfolio. I don't have all my money in U.S. stocks, or certainly not large U.S. stocks. I have about 10 or 15% in small cap stocks. I have about 20% in international stocks. So I have a very well-diversified portfolio to begin with. Now, because U.S. stocks have continued to go up, it has taken that balance out a little bit. So with new investments, whether it's 401k contributions or additional investments I can make in our taxable accounts, I'm pretty much focused on three kinds of investments: small cap, value, and international, because I think their valuations are much more attractive, one. And two, again, I don't have a set defined allocation for each of those sort of sub-asset classes that I have to have. But what I do have has gone down as U.S. stocks have gone up. Now, this year, international has done a little bit better, so it hasn't been dramatic. And also, these new contributions won't end up making some major change to my asset allocation. But I just think it's a smart thing to do. Again, it's not a prediction about what the U.S. markets will do in the short term, but I think it's just sensible to realign your asset allocation when some assets just grow and grow and grow. And in my case, it's not only the total U.S. stock market index, but also I have pretty significant allocation in Apple, So I'm working on that. That's a whole other issue, but that's my plan. So am I making any major changes to my asset allocation? No. I am taking new contributions into asset classes that I think are undervalued, or at least relative to U.S. stocks. And I'm not getting too married, if you will, to the U.S. stock valuations, because they're not here to stay. There will be changes at some point, and we will start to go back to some mean somewhere at some point. I just don't know when. At least that's what I believe. Okay, great question though. Next one. How should RMDs affect our investment decisions? So I took some of this email out just to protect confidential information, but it comes from Steve. He has a mom in her 80s, and she has an IRA that she will not spend. It's her choice. She's not going to spend it. Going to leave it to family. And the question, as you can see, is what is the best way to look at the asset allocation for my mom's IRA, knowing that eventually, once she passes, it's going to go to a non-spouse, right? So it's not going to be a spouse that inherits this. So the folks that inherit it will have to deplete it within 10 years, right? So the question is, so how should we think about asset allocation now, given that? So here's my take. My starting point is when will you spend the money? Not when will you have to take it out of the IRA. Not when will our RMDs, required minimum distributions, begin. Because you can take the money out of the IRA and then put it in your taxable account and keep investing it, right? So to me, the question is, when will you need the money? Now, in this case, it's complicated, because you don't know when someone will pass away, and then you've got a 10-year period. But you can make an estimate of that. But the answer may be, well, I'm not going to need it for 20 or 30 years. Even, I'm not going to, just because it's an RMD, you're right, Rob, I'm not going to spend it. Then in my view, I would probably allocate it pretty aggressively. Now, exactly what that means would depend on your own risk tolerance, discussions with your mom. Is it a 90-10 portfolio, 80-20 portfolio? I don't know exactly. But it would be heavily weighted to stocks if we're not going to need the money for several decades. On the other hand, if you're going to start taking it out and spending it shortly, after you inherit it, then, I might change that. I might go to a more conservative allocation. Again, it just depends on your best estimate of the time period. But the thing I want to focus on here is the timing of the RMD is in and of itself irrelevant unless the timing of the RMD happens to coincide with when you plan to spend the money. By the way, that's often the case when you're in retirement and the RMD is for your own account, right? But in this case, I get the sense that Steve's not going to be in a hurry to spend the money. So for me, I wouldn't use the timing of the RMD to determine how I invested the money. At least that's how I would look at it. Okay. Next question. What is the efficient frontier and how can it help me invest? Comes from James. Would you explain the efficient frontier? I used to focus on it as a theoretical investing principle, but I don't anymore. I'm willing to give up some investing purity in exchange for other factors these days. Okay, well, great question. So I'll show you the efficient frontier. I'm going to show it to you. Just bear with me. But first, let's just talk conceptually what it is. You can think of it as how can you earn the highest return with the lowest risk? Or given lower risk, how can you get the highest return? So for example, let's imagine there were only two ways to invest, and they both earn 10%. That's with the return over some period of time. The one that would be on the efficient frontier would be the one that has the lowest risk. Again, given that they're both have a 10% return. And risk would be defined as volatility, standard deviation, how much the prices go up and down, right? And so if they both earn 10%, the efficient frontier, the one that would be on that line would be the one with the lowest risk. And we could reverse that. We could say, well, we've got two portfolios that both have a standard deviation of 15. So which one's on the efficient frontier? Well, whichever one of those generates the highest return. So we could look at it either way. So let me show it to you, and then I'll tell you how I think about it in terms of practical use. So you can do this too. I'll walk through it, but this is Portfolio Visualizer. There's a paid version, but there's a lot of good stuff in here for free, which is what I'm going to show you. And they've actually got this efficient frontier here. And you can put in tickers. It'll limit the data. So we're going to, at least if you're using the free version, so I'm going to use asset classes. And we'll just pick some. U.S. stock market. We'll pick. Let's do global, international stock market. Let's do REITs maybe. Where are REITs? Why can't I find the REITs? Here we go. And let's just for good measure throw in some gold. Now already you can see I'm making some choices about the asset classes, which is an important point. There is no one efficient frontier. There's thousands of them depending on what asset classes you choose and also what time period you look at. All right. So don't think of the efficient frontier as one thing. So we'll put an allocation in here. Let's say, I don't know, 40%. I'm not going to do minimum maximum weights. We could, but I'm going to keep it simple. We'll do, I don't know, 30% for international. We'll do 15%, if I got the math right, and 15% gold. There we go. And so we come down here, we get this kind of crazy thing. This is the efficient frontier. So the way to think about this is we could pick any spot. So in this spot right here, and it may be a little hard for you to see it. Let me see if I can make it bigger. I don't know if that helps or not. This dot right here has an expected return of 10.85%. This happens to be from January 94 to last month. And to get that return at the lowest standard deviation, right, you would need a portfolio of 90.24% of U.S. stocks, gold of 9.76%, and no REITs and no international. And here you might be saying, all right, Rob, but if we go back to January 1994, is this chart available back then? Like, is there someone that can portfolio visualizer tell me going forward what this is going to look like? And the answer is no, they can't. They have no idea what it's going to be going forward because none of us do. The efficient frontier is a backward-looking measure. We have no idea, given whatever group of asset classes we want to put together, are going to be on the efficient frontier going forward over what period of time. There's no way to know. In fact, the other thing we could do is we could change the time period and we'd get a different answer. Now, here's the portfolio that I typed in with the different returns or different percentages, and you can see it falls well short. It has an expected return of 918, but it has a standard deviation of 1323. Now, if we come up here, let's see if we can find 918. Where is it? I guess what they're doing is based on risk. The point is, you could get a much higher expected return with the same amount of risk. Risk is down here on the x-axis, and you could get similar. Let's see, standard deviation 1323, so it's right about here. So with 83% U.S. stocks and 16% gold, I can get a much higher expected return with the same standard deviation, right? And you can see gold by itself was a terrible investment. And even REITs, were really volatile and didn't get the same return as a total U.S. stock market, right? Now, so you probably figure out my answer. I think the concept of an efficient frontier from a what do we do now, how do we invest now perspective it's of no use. I find no use in it. I think conceptually it can be kind of helpful to understand that adding even riskier assets can reduce the volatility of a portfolio while maintaining the same or maybe even a higher return. But there's no way to know in advance what the right mix of asset classes will be. There's just no way to know. And we didn't even put in there Bitcoin, which is going to completely throw off everything. So yeah, I wouldn't worry too much about the efficient frontier. That's my take. And those that disagree are welcome to, put a comment beneath the video. Okay, next question. How to factor illiquid investments into asset allocation. This is kind of a long email, but the long and short of it is Fred has a lot of assets that he can't sell that an advisor put him in. Some of them are notes, some real estate funds. You can see some oil and gas and private credit and debt. It's kind of a mess. They're performing fine, he says, but he has to hold on to them for 2 to 6 years, can't sell them. And he's like, well, how do I think about those? Do I think about, should they be fixed income? How should I work those into my asset allocation? And the first thing I'll say is I've never had this problem. I've not invested in these sorts of assets in the past, but I know a lot of people might have this issue. And the way I would think about it is, first, are the assets truly fixed income? And they could be. Are they debt of some sort? Are you a lender to some entity, and they're paying an interest rate? Maybe they're callable, maybe they're not. But are you a lender or not? Or are you an equity owner? Could be real estate, right? You could be an equity owner in real estate. You could be an equity owner in some oil and gas investments. And that's how I would think about the allocation going forward. I think the good news is that he's going to be out of these in 2 to 6 years. And then once he's out of them, hopefully they perform well, he can invest them, in a different way. But while he's waiting, that's how I would think about these. Do they most closely align with debt or equity? And if they're debt, I would probably include them in fixed income. The only hesitation I have is that if I thought they were really, really risky, they were really on the high yield end of debt, really extreme risk, then I might see those as behaving more like equity than debt. But short of that, I would try to do my best to understand the risks of each investment. Again, am I a debt holder? Am I holding debt that I've lent money to folks, or am I an equity owner? Again, could be real estate, could be oil and gas, whatever. There could be times when maybe investments kind of have a little bit of both. And so you just have to figure that out and make your best judgment. It's kind of hard to evaluate that in the abstract, but that's what I would do. And then I would add those to the appropriate allocation of my overall portfolio. I kind of think it's good enough. It may not be a perfect solution, but again, the good news is it's short term. So, yeah. All right. The fifth question. This comes from Tom. If the purpose of bonds, the bond portion of a portfolio, is to reduce volatility, why would someone use BND, that's a Vanguard Total Bond, U.S. Bond Index Fund, instead of SGov, which is also a fund, but it invests in short-term government bonds? A back test via Testfolio shows much less volatility and better performance by SGov. So let's take a look at that. I actually pulled that up. Let me show it to you. Here it is. And sure enough, the blue line is BND. The red line is SGov. Not only does the blue line tank and kind of fall below, but you can see it's jittery. It's up and down, and the red line is just nice and smooth, and it's like a plane taking off, or how you want a plane to take off. So isn't, to his point, it sure seems like SGov is the way to go. Well, the thing I would say is that this is over a very short period of time, from 2020, and I think the reason it's only 5 years is probably because that's the availability of data for SGov. In fact, yeah, that's exactly what it is. SGov has, isn't that old of a fund. So it's only over about a 5-year period. I wouldn't draw too many conclusions about these two funds over 5 years. The other thing I would do is I would look into this time period and I say, well, is there anything going on here that maybe caused all of this? And you'll notice that they were actually neck and neck until right here. What happened in January of 2022? Well, recall we hit inflation of 9% that year. The stock market tanked, the bond market tanked. BND is an intermediate term bond fund, so it lost money. Now, since it lost money, it's come up and it's kind of, bumped up and down, but gone up a little bit. But it's really 2022 that's the problem. In fact, I don't know what this would look like if we gave a different starting date. I didn't try this ahead of time. I probably should have. Let's see here. But let's go to 23. We'll start it in January on the 1st. What did it give us? So in this case, SGov still outperformed by about $100, $100 and $200, but it was much closer, right? So you might look at this and say, okay, Rob, but that kind of still proves the point. But here's the deal. Longer term, intermediate term bonds outperform short term bonds. The last few years have been very unique. And remember, and we kind of see part of this reflected in this chart as well, I think, is even after we got through 2022, the yield curve was often inverted, meaning shorter term bonds had higher yields than longer dated bonds. And that happens from time to time. It's often, although not always, an indicator of recession. Some folks like to say that the inverted yield curve has predicted, 20 of the last, 15 recessions. But that no doubt played a role in the data we're seeing. I will say at the end of the day, is a shorter term bond fund the end of the world for a diversified portfolio? Probably not. But when you do look long term, intermediate term bonds do outperform. And I can tell you, a lot of the tests over different withdrawal strategies, including Bill Bingen's 4% rule, uses intermediate term bonds. So if you use short term bonds, you would get a different answer. Now, would it be dramatically different? I doubt it, but it would be lower. So yeah, over the last few years, it made sense to be in short-term bonds. Frankly, there are times when I would have preferred my entire portfolio, including the stocks, to be in short-term bonds. But longer term, no, I don't think so. So again, I think at the end of the day, for me, I'm fine with BND. Keep in mind that BND has some shorter-term bonds. The fact that it's an intermediate-term bond fund just means on average, weighted average, that's what it comes out to. But it's got shorter bonds as well. So it's a mix of things. I'm just more comfortable with that. Although I do hold our cash and emergency fund and spending over the next year in shorter term funds. I've used SGov in the past, and VBill from Vanguard is another one. I use certain money market funds. So, I do have some short term bond funds in our portfolio, but for sort of the longer term money, I'm personally more comfortable with intermediate term bonds. And there's nothing that I see in the last 5 years that would change my view on that longer term. So that's my take on it, but great question. Well, there you go. If you have any questions, leave them in the comments below. Be happy to help you out any way I can. And until next time, remember, the best thing money can buy is financial freedom.